Hey guys, welcome back to the show. My name is Akil Stokes, Forex trader and trading coach over at tier1trading.com, and welcome back to the Trading Coach Podcast. Today I have a very special episode in store for you, as I'm going to give you a behind the scenes look at a recent presentation that I did for a group of traders, talking about why the market moves and teaching the 3 things that cause it to move. Now, if you're interested in ever joining one of our presentations, one of our workshops, we do an amazing job, and we have one coming up in March. I'll get you the details as soon as they come out, but stay in the loop. Watch this space. That means the Trading Coach Podcast. That means the YouTube channel. Of course, that means over at tier1trading.com as well, and you won't miss it. I give you advance warning because we do cap the amount of people that we allow to attend the workshop. So since you're in the know, hopefully it gives you a little bit of a head start in preparing yourself to take advantage and claim those seats before they're taken. All right, let's hop in. So what moves the markets? We know about how the market moves. We spoke about a little bit of this already, but what moves the markets? Well, 3 things, right? Fundamental, technical, and psychologicals, if that's a word, right? Fundamentals are things like news releases, earnings, changes in leaderships, new products coming out, mergers, acquisitions. There's inflation data, interest rates, unemployment, employment, GDP, et cetera, right? These are like the news events, the things that are happening with particular economies or particular stocks. There is technicals, right? Technicals are what we look at on the chart, right? These are key levels, support and resistance. Someone mentioned supply and demand earlier. Different price patterns, historical price patterns, advanced price patterns. There's classic price patterns, simple, complex, all types of price patterns. But everything that you see on the chart is a pattern in some way or not. There is volume. Which is, I guess we could put that under indicators as well, but volume that tells you how many people are actually buying and selling, what the interest is. There are candlestick patterns, there are different indicators. Another thing with indicators, I'm not a big indicator fan as far as using it to predict price action, right? So I'm not one of the people that says, oh, this indicator will tell me that. Rather, an indicator is a good confirmation. It's a good filter. All indicators lag, yes. All price action lags as well. Yes, you can put them under the same category. But the thing is, even if there is a certain indicator, let's take a 200 period moving average, right? Which in its own right means completely nothing, right? Why 200? What does 200 mean? It means absolutely nothing. But if a large group of people believe that the 200 moving average is important, then doesn't that make it important? What would you guys say? Yeah, because it's not what the indicator is doing. It's me being able to read other investors. So although I may think something is stupid, if the vast majority of traders in the markets, and they say it on TV all the time, if you listen to these pundits, where it's like, this hit the 200 period moving average, which, if we stay above that, blah, 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 if they feel it's important, therefore it becomes important, right? And then the last part is going to be psychological, right? These are our emotional responses. Go back to the first session where we showed you guys the greed and the fear chart, right? Greed, fear, confidence, anxiety, euphoria, dysphoria, stuff like that, dealing with pleasure, dealing with pain and the different states that you're in. And again, going back to trading is and investing, it's much less about understanding numbers and data, just like the book I showed you, and more about understanding human behavior patterns, crowd, herd behavior, right? And this is what Thomas Sowell was doing in that book of his. He was talking about those relationships. Self-fulfilling prophecy, yeah, in a way, yeah. In a way. I'll give you a good example. As human beings, we like what numbers are more comfortable for us as humans? If I gave you 2 numbers, if I gave you 199.93 and 199 even, what number is more comfortable for us? It's the 199 even, right? So we call these psychological levels or even handled numbers. if you look at a price chart, and you do it right now if you're able to pull one up, as long as you keep us up because this is important. Pay attention to what price does when it hits these levels that end in 0 zeros. And you'll see that it tends to respect them the same way it would respect any other type of support and resistance level. And the question is why? Why is 199 even more important than, 199.93? Right? It's not. Aside from the fact that we believe it is. It's the same reason that stores sell stuff for $19.99 instead of $20. Because $20 seems big, but $19.99, oh, we see that as a 19, even though it's the same exact thing as 20, right? I had a perfect example of this with my kids where we were in the store buying some toys and whatnot. And they're looking at prices and I'm trying to teach them stuff on spending and managing money and stuff like that. And I'm looking at stuff and I'm like, hey, do you really want to spend $20 on that? He's like, Dad, it's not $20, it's 19. I'm like, what are you talking about? It's 20, right? It says $19.99. He's like, no, it says 19. Kids are super literal. And I'm like, boom, it's for him, it's $1 less. It's really a penny less, but for him, it's $1. Yes, because we see 20 and then we see 19.99, right? So it's psychological levels. These things are important because we make them important. And if we can understand that as traders, these help increase our edge, right? Jason Greystone would never place a stop loss right at $1.99 even. Would you, Jason? He would never place a stop loss right at $1.99 even. Why? Because he knows the market's going to get sucked to that level. So he would hide it below. He would use that level as protection. And we probably have hundreds of trades. We probably have hundreds of trades. I should have said the direction. That would have made more sense, right? We probably have hundreds of trades where we've saved our behinds simply by avoiding one of those levels. And I'm sure you guys have had plenty of trades where you get stopped out and then the market goes back in your direction because you had it at that level. And it's not stop hunting. It's just not us being uninformed about the proper place to put these things, right? So it's small things like that increase your edge. Hope you enjoyed the presentation. Again, we have another workshop coming up in March. I'll give you details as they come, but make sure you're subscribed to the YouTube channel. Make sure you're a follower of the Trading Coach podcast, and make sure you just pay attention to what we're doing in the different social media spaces. That way you don't miss the announcement. All right, until next time, plan your trade, trade your plan. Take care.